Hello, everybody. This is Kirk Spano. It is July 7th, 2022. I am back from Vegas. I am over COVID, and we're going to review a couple things we talked about last week, but really review the 2022 forecast and what I'm doing to adjust to the parts I got wrong, which weren't many, and what I see going forward the second half of the year. So while people file in, let's start with a little story. I went to Vegas three and a half weeks ago and basically took 3 weeks off and did very little because there wasn't a lot to do. The stock market hasn't bottomed out yet. We haven't gotten huge volatility yet. The Fed is still tickling us with different things from week to week. And the reality is that inflation, though it's starting to subside, hasn't really fallen to the point yet where I think the Fed is going to back off. However, as we'll talk about in a few minutes, I do think we're going to get there this year, probably in the fall, almost exactly when I forecast that they would have to back off. In any case, Vegas trip, because I know everybody cares. I played in 3 World Series of Poker events, and I cashed in 2. That's a very small sample size, but most professionals would consider that outstanding. I took 60th in the senior event, a little over 7,000 people, took home over $12,000. And then, because I've never done it before on the World Series stage, other than a small circuit event, I played PL08, so pot limit Omaha 8. What that means is that there's a high hand and a low hand. And I cashed in that event too. Not very good cash, just a min cash. Got my money back plus like $800. So it was a pretty cool trip for me. I also won a tournament at Caesars. So all in all, very profitable trip, the most profitable trip I've ever had to Las Vegas. And what put me over the top were 3 sessions of craps that I just played to get points for my Caesars rewards. But I ended up $3,000 in craps. I don't quite understand how it happened, but I was smart enough to leave when I was up, because craps is a 50-50 game, actually a little bit against you. So when you're up $3,000, you should probably leave, because those dice are going to go cold. I ran all the numbers, which is a prop bet. What that means is that I hit every number on the board before 7 came up. And I didn't know there was a prop bet for this, but it paid 150 to 1. I was playing crapless craps. So only 7s were crap cards, or the crap dice, and 2s, 3s, 11s, and 12s played. So I hit every number 2 through 12 without hitting a 7. Well, some guy had $50 on that. Got 150 to 1. He started putting money on the table. I was like, what's going on? Well, so I started betting on myself to hit that the next couple times, and I missed by 2 and 3. But it was still a lot of fun. Ended up $3,000 that are good in craps. I don't know. That was actually the most fun I had, but I can see how people get addicted to gambling, because when you're making that much money and you're like, well, gee whiz, that basically pays for all the airfare and hotel and meals. You're like, maybe I should play more craps. But you shouldn't play more craps. Playing more craps is a bad idea. Always leave when you're up in games of chance. That is something that my great uncle taught me. He was a floor person and pit boss at the Riviera for 35 years. So that is my lesson. If you're going to gamble in Vegas and on a budget. If you do happen to get up, go do something else. Go hang out at the pool or whatever. I went shopping because, it was time to go shopping before I left. The stock market is not something you want to gamble with, though. So get your yayas out somewhere else. In the stock market, we're looking for a margin of safety. We want to invest when the risk is lowest. And when we invest in something that's cheap, but it continues to get cheap, people freak out. Oh my gosh, we should have waited. Well, here's the thing. Value is value. Price is price. If we know that something's going to be worth $3, $4, $5 billion in 3, 4, 5 years, because we can see all the documents, all the contracts, all the cash flows, and it's trading for 200 or 300 million today, then we just buy it. And if it goes down in price, we buy a little bit more. If it goes down in price even more, we buy a little bit more. And that is just something I want to emphasize, is that price does what price does at the margins, because the dumb money, the retail investor, panic buys and panic sells, and the traders gang up on little stocks. Interest rates were so low up until recently that the short investors were able to just destroy certain stocks. in particular, the former SPACs, and really anything small cap. If it's under $1 billion, they've had their way with it, and they've just beaten the heck out of the small caps. I believe that we have a generational opportunity in small caps right now, and that article will get published in a brushed up version next week. I've already put one out, but I'm going to put out a brushed up version next week so that it meets the editorial standards of Seeking Alpha. As I talked about, a year and a half ago, almost 2 years ago now, when I talked about trading and how the traders had exceptional power because of the zero interest rates. They're able to bet on things without much of an interest cost. They were able to push stocks down and up first and now down, overshoot in both directions. And it's happened in small caps already. I think we're kind of at the bottom in mid caps for the most part. It could wiggle more, but I think the mid caps are just about done falling as well. If there's one more big panic surge down, then so be it. But you gotta remember, most people who panic are large cap investors. So I still am keeping an eye on the large caps. Tell me when this bear market is over. And I believe it'll be sometime this year. Now, read these 3 articles, my forecast, the article on valuations. These are all free at Seeking Alpha. You might have to be a premium member. So free if you're a premium member. The historical revaluation and how low can the stock markets go. So I've updated that, and this article isn't done. The 2002 forecast review and update, not done yet. However, I just want you to kind of understand where we're at. The dollar has risen substantially. Stocks, as forecasts, have been correcting for over a year now. First the small caps and the mid caps, and now finally the large caps. REITs are taking it on the chin with rising interest rates, but there is value starting to emerge. Not quite there yet. And then Bitcoin dropped to that $20,000 range I talked about in 2 different webinars. And I actually copied the minutes, I believe. Here you go. There you go. This was way back in January when Bitcoin was over 50,000. And I said I'd be looking to buy it again in the 20s. I think that 20 to 30,000 range is what we got to look for. And in another piece, I talked about how I thought Bitcoin for sure was going to 30,000 and probably going to 20,000. And that's right where it's been bouncing around, is right around 20,000. There's some technical reasons to it. And Bitcoin has a lot of adoption pains going on right now. And we'll finish up with that. But if you take a look at this forecast and really go back and read it, you will see that it's been just about spot on. This might be the best forecast I've ever done. And the only other one that might have been as good was my annual letter in January of 2008, where I told people I thought 2008 was going to be a really bad year. I believe that the problems at Bear Stearns are the tip of the iceberg regarding problems that are likely to emerge in the financial sector. How would you have liked to have been working with a financial guy that said that 9 months before the crash or 8 months before the crash? So when I do a forecast, it is based on setting our base scenario, the thing that we think is most likely to happen, but then identifying 2 or 3 other things that could happen. And that's where my S&P 500 chart comes in. So, we raised cash late last year, expanded our small cap holdings into the decimated markets, just started to invest in mid caps in Q2, and just starting to nibble on Bitcoin again and Bitcoin stocks. So if we respect the cycles, let's see if I can get that to pop. I can't. If we respect the cycles, then what we can see is that different markets, different industries are at different spots in the hype cycle, right? So this is the Gartner hype cycle. And we've seen this chart a million times. Something gets hyped up, price goes up and up and up and up and up. And then investors get impatient because tomorrow isn't happening fast enough. And the stock goes down, 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 down. And then time and execution and adoption get it to rise again. Sometimes it gets way back up here. Sometimes it doesn't. It'll be a slower grind up the second time. So we have all of these different industries that many peaked around New Year. AI, different sorts of things. These are real young technologies here. But think of all the different things that peaked around New Year. And now they're way down here somewhere. Where are they here? Some people are telling you that it's already here. I don't buy that for a minute. I think what we're getting is a rebound rally in the stock market. And probably after the next Fed meeting, unless they surprisingly back off sooner than I thought, we're probably going to get a lot of fear. especially if they raise 75 basis points, which I think they're going to. And here's why. A, the market is pricing it in, so they have cover. And B, they really want to reload that bazooka as fast as they can, which I've talked about in other articles. This is all about the Fed reloading its bazooka for the potential baby boomer crisis that we're going to have 4, 5, 6, 7, 8 years out. One of our subscribers keeps emailing me about 10,000 baby boomers turning 65 every day. Well, gee whiz, I've known that for 20 years. But most people just don't grab onto it. The demographics, our destiny arguments have always, without exception, always been right every single time. Demographics drive economics. In the future, economics will be driven by demographics and robots, machine learning, because we're going into an era where people just don't want to do certain things like mining all the materials that we need to build our EVs and our solar powered plants and different sorts of things that we're going to be doing over the next 20, 30, 40 years. So those Ford robots or other robots that I've shown you, the ones that were just dancing on 60 Minutes on Sunday, that are 10 times stronger than us, just as agile, and are either smarter than us or can at least be as smart as us with us at the joystick, are going to be doing a lot of the heavy labor. Construction already happening, mining already happening, all sorts of manufacturing also already happening. It's just going to continue to adopt from a fraction to a significant minority to a majority of certain jobs. Middle managers, because of AI, are going to become redundant and unnecessary. Middle managers without really great interpersonal skills are going to go away. That fiefdom manager who just looked over your shoulder to look like they were doing something important, they're not going to be around anymore. Because if you don't have communication skills, what are you needed for if the AI can do most of the hard stuff faster? So in a world of social media where people are unlearning how to communicate, communication is going to become one of the most important skills. I say that based on the studies, based on observations in business, and based on personal observations. I see how hard it is for certain young people to communicate. And I see my paychecks coming in for basically writing down my research notes, bits and pieces of my research notes, because I don't want it all getting out. I write in a way that apparently is fairly easy to read. And I speak in a way that I must be fairly easy to understand, even though my voice is, funny Midwest guy, upper Midwest. But communication, I'll tell you, if you can influence your kids and grandkids, nieces and nephews, to read a lot more from books, paper pages, which studies have shown are about 2 to 3 times more impactful on retention and learning than reading off a screen, which is, it's not a horrible idea to print my articles and read the paper and mark them up, then you're doing a good thing for your kids, grandkids, and nieces and nephews, because the communicators of the future are going to be paid well. And it might make sense just to go get a law degree for a lot of these kids, whether or not they intend to practice law, because you will become a good communicator if you study law. In any case, somebody says, do improv comedy. Well, I did improv comedy for a year, mainly just because I was getting my drinks for free. And I think any type of stand-up, any type of speaking, kids who say, I don't like speaking from a crowd, you say, tough, go do it anyway. In fact, do it more until you get to the point where it's easy. A lot of movie stars say that they have stage fright, but yet they are right on stage, I'm telling you. So they figure it out. So a lot of these things that are on the early adoption scale are going to be augmented by fantastic communicators. So there you go. That's my little piece of wisdom that's not quite investment related, other than one of our big investment baskets. What is it? Media. Tell you what, those media companies that we've been investing in, that basket of 5 now, and maybe 6 soon, I think is going to crush the market over the next decade. I think their cash flows are going to be through the roof. I think that their expenses are going to be held in check. And I think that ultimately there is going to be a massive switch back to the mainstream media, because as we've seen, 80 to 90% of the blogosphere is bullshit. It's just people trying to get a click and a penny. If they can get 1 million clicks and pennies, hey, there you go. They've made their money that year. So be judicious in what you read on the internet. And if there's not a proven track record like I have, don't read it. Honestly, don't read it. If it's tied to a political organization, don't read it. If it's tied to some sort of organization that's funded by a special interest, oil, Wall Street, whatever. Don't read it. It's not worth your time, and it's got a slant. There's a lot of things out there that aren't slanted, or at least give you both sides of the story, which is what the fairness doctrine used to be all about, but politicians got rid of it because why talk about everything when you can just talk about the stuff that people who might vote for you want to hear? So if we all become more discerning at every level of our life, including investing, things not only get better for ourselves, it's better for society. So in this review, I go through some of the things that happen over and over again, right? So this chart here, if you think about the adoption curve and you imagine every single one of those topics, every industry is its own separate chart. Close your eyes and imagine all those lines not overlapping, a series of lines. Make it three-dimensional if you can view it that way. Imagine the smart money investing. Where's the smart money going to invest? They're going to invest in two places on this chart, right? They're going to invest here, and they're going to sell up here, and then they're going to reinvest here. It happens over and over again. Smart money invests, dumb money pushes it higher, then dumb money panics after the smart money has sold it to them, and then they panic, we get a trough, and the smart money buys back in. And then the adoption is slower the second time because people are here going, well, I lost money on solar before, so I'm not going to buy it. I lost money on Kinder Morgan before, so I'm not going to buy it. I lost money on AT&T before, so I'm not going to buy it. And meanwhile, these things just trace higher and higher and higher, and eventually hit an inflection point where they really start to move. Rinse and repeat, right? The prices overshoot too high, like they did last year, and now a lot of prices on small and mid caps have overshot too low. They could still certainly go lower, but value is value. Like I said earlier, value is value. And after the smart money has established their positions, which is what you should be starting to do now, the narratives will hit the internet, the newsletters will pump, and the knows very little to nothing retail money, which is the nice way of saying the dumb money, catches FOMO finally again and drives prices too high for the smart money to sell into. Again, rinse and repeat. You have to get over the idea that trader narratives are somehow helpful to you if you're not a trader. If you're a professional trader and you're very good at it, or a very, very good amateur, and you understand that narratives are for 2 weeks usually, not for 2 years, then you'll know that you should generally be a contrarian if you're an investor. So if the trader narrative is that oil could go to 250, but it's been dropping for the last couple of weeks, maybe it's that oil demand is completely flattening out again like it did in 2018 and 19, and there just isn't a lot of demand push. And maybe the United States has started to produce more oil, which they have, and Canada is about to send 600,000 more barrels to the United States refineries by next year, and Iran might cut a deal, and Venezuela already added 120,000 barrels a day since I talked about it a few months ago. They're never going to get back to 3 million barrels a day, but they'll get back to 1 million barrels a day from 400 and whatever thousand they're at right now. And that'll be the heavy oil that we need to operate our refineries, because it's not a shortage of oil that's got the price of gasoline high. It's a shortage of refining space, because we closed 8% of our refineries, and like 3 or 4% of the refineries globally closed during COVID. And in fact, about 1/3 of Chinese refineries are idle right now. It's not an oil shortage. It's a refining issue. And all but one of the refineries that closed during COVID in the United States that I have found are all reopening as biofuel. It can be biodiesel or biojet fuel. And most of them are using corn, except a little one in California that's collecting cow poop. I forget what the name of it was, if there's an official name for that. And taking old orchards, instead of burning them, converting them into jet fuel. So instead of taking corn, which is edible, they're taking orchards, mainly almonds, that are at the end of their usable life, and they turn them into jet fuel, right? There's a process, but they've been building the facilities because they have the financing from a 15-year partner that all they want is a little bit of equity. If you take a look at the refining industry, why would Chevron and Marathon and a few others be converting to biofuels? It's because there's a lot of waste out there. Don't even have to grow it specifically. Orchards only last 10 to 20 years. Kind of makes you think that all those apple orchards and all those peach orchards and all those orange orchards could just be chipped, thrown on the trucks, and take it to a biofuel refinery at some point. And Joe Manchin, as one of the conditions of him signing the balanced Build Back Better, which I'm pretty sure they're going to use that name because they're describing exactly what I've told you for 7 or 8 months now that they're going to do. About a little over $1 trillion balanced, build back better. They're only going to spend what they bring in from the corporate income tax. So you take a look at things and you ask, if I follow the money, what happens, right? If you follow the money, you're going to know what's coming sooner than 98% of the population, right? Because the big money is all in the hands of 1 or 2% of the people. If the billionaires are investing in something, even if the specific company they're investing in is wrong, doesn't execute, whatever, the idea is probably pretty sound. So when a guy like Wes Edens finds a technology for creating liquefied natural gas at the wellhead, right? Doesn't have to ship it, pipe it to a facility. He brings the liquefied natural gas facility to the well on the ocean and loads the ships right there and sends them off to, say, Europe or Japan or China. And he's putting his own money in there, self-made billionaire. You got to start thinking to yourself, boy, this one might be a layup because the price of natural gas has gone up way more than the price of oil. And there's not a way to divert Russian natural gas from Europe to China, right? They have to build a lot more pipelines, and that won't be quick. Unlike oil, which they just put it on a different ship, different truck, whatever. So natural gas is really the big problem because the clean energy revolution is going to take some time. Even though that FERC report that we referred to a few weeks ago, FERC, Federal Energy Regulation Committee, I think that's what it stands for, Commission, I think it's Commission, has said that if every single solar project was built that's already proposed and financed and hooked up to the grid, suddenly being better part of a decade, the United States would have 80% of its electricity from solar based on today's usage, which is going to go up. So probably be closer to half. Can you imagine going from 10% solar to 50% solar? And the increase in use in solar is mainly EVs because electricity use has been stable now for a better part of 20 years. Why? Because of efficiency. Any of you have insulated a house in the last 20 years? How much did your energy bill change when you put in the better insulation or the new windows or the new central air system, right? Every building in America and really globally has become more efficient in the last 20 years. And that's why we've become less energy intensive. That's true. We've become less energy intensive. It's only the population growth that's added. So you look at any of those charts, you realize, all these people who argue that emerging markets are going to lead to more oil demand, they're wrong. Here's the analogy. Did they all start building malls 10 years ago in the emerging markets? No. They went straight from not having a lot of retail to having online retail. They skipped the mall phase. And they're doing the same thing with transportation. As they become more affluent and more people afford cars, and the governments realized that they didn't want internal combustion engine cars all over the place, you saw two things. One, the first thing you saw was mass transit, which is morphed into ride sharing as well. And now you have the EV revolution. And EV growth rates are higher all over the world than they are in the United States. In the United States, it's pretty high. So when you think about these things, and you take a look at my forecast earlier, I think the thing that you have to think about is how much and how fast are things going to change. I really do not know why these are not popping out. Well, this one is. So when we talk about the dollar, we can talk about way back. Here we go. Here's the chart from January. And if you go all the way back to when Joe Biden was elected, the same chart, I said that this would be a local bottom, and it was. The dollar went up. When it got to here, people said, well, I can't go up much more. I said, oh, yeah, get the yellow line, maybe go past it a little bit. And that's where we are now. Look what the dollar has done. So all these people chanting fiat currency, fiat currency, fiat currency, have gotten it completely wrong. The dollar has been getting stronger since I wrote the articles in 2012, early 2012, right about there. When this little rally happened, everybody was calling for the collapse of the dollar. Go back and read articles from 2012. Everybody was calling for the collapse of the dollar. And what happened instead? Big jump, new range. Now another big jump. I don't think we're going to hold this range. I think later in the year, the dollar starts to come down, and then the stock market will go up. But ultimately, as the petrodollar collapses, it'll just be the dollar. That is the de facto, in facto reserve currency for the rest of our lifetimes. Why? Because our economy is that much stronger than any other major economy. It's not even close. The rupee probably will appreciate as well. And what's coming as supply chains migrate to America, and the United States economy flexes muscles during what's going to be a millennial boom as they reach peak earning and spending, which is imminent, as those 10,000 baby boomers a day retire. You're going to see the dollar trading up here for a very long time, very long time. And that's going to be great for standard of living in the United States, but also probably Canada, because they'll drift with us, and Mexico. So, I've talked about real estate a lot of times, and I was just in Vegas and I talked to some big time real estate investors, along with some big time media people and some big time tech people and a couple hedge fund guys and a couple private equity guys. I was very busy between poker sessions and going nuts on the crap stable. If you want to buy real estate in Mexico and you have the cash to do it, and you legitimately want to spend a lot of time there, man, I tell you what, the next year or two, you might want to buy that real estate in Mexico. Because I really can't see things getting worse in Mexico over the next 10, 20 years. Granted, don't, sell your house here, but if you've got that extra $200,000, $300,000, $400,000 laying around, sitting in the bank, and you're smart at how you pick out real estate, right? Buy a fixer-upper in a great neighborhood or in a great area and put the remodel money in, because that's all over the place. I'm looking in Puerto Rico again because it's just too darn hot in Vegas, and I don't want to be there 6 months a year. But in Puerto Rico, there's still all kinds of properties. I found one with beach access, but it was a very long, thin lot. So you didn't have to put the buildings within even a quarter mile. It was like a quarter mile off the beach. So you put the buildings at the back edge of the property. It's a quarter mile to the beach, but it's a straight line. You own it. And you could have 8 buildings there for $250,000. Beachfront property in, one of the main towns. So when you take a look at things and you start thinking, okay, where do I want to hold my money, my excess money, my multi-generational money in particular, it almost always comes back to real estate, unless you're really rich, and then Bitcoin is a thing. But what do the super wealthy buy? They buy real estate that has long-term value, but is short-term depressed, but can generate some income in the meantime. Farmland, Bill Gates, biggest farmland owner in America now, caught up in past Ted Turner. Because Bill Gates has more money. And the reason I focus on these things is because you have tangibles and intangibles. The dollar is kind of intangible in your mind, but it's real. It directly affects your standard of living. So they're pushing the value of the dollar up because it's a way to fight back against Saudi Arabia, Russia, and China. More Saudi Arabia and Russia, mostly Russia, but Saudi Arabia owns a lot of dollars, and so does China. So the stock market's under pressure because the dollar is going up. And soon enough, I'm guessing September, I can be off by 2 months in either direction, I think, this dollar is going to start coming down. TLT will rally. We're getting close to TLT being a buy, and the stocks will rally. And usually coming out of this sort of thing, the small caps rally the most, even though everybody still pays attention to the large caps. And the mid caps, over the full cycle, usually are the biggest winner. So it's kind of front loaded to the small caps early, backloaded to the large caps late, which is what we just saw. And the mid caps are just generally good performers all the way through. So when this starts coming down, you're going to want to be fully invested quick, because the stock market has almost a direct correlation to the big moves in the stock market and even the trading moves. So what stocks we want to look at? All right. So here's the first chart. This is the S&P 500 from January 25th. Put the buy zone right down here. I've changed some of this because for years I told you that I thought that 2016 was the floor in the stock market, but I didn't use it for building my charts because I wanted to focus on shorter term time frames. Well, now we want to look at the full giant 6-year, 7-year cycle. And I've switched to using this bottom in 2016 to build my charts. And this is where a particular Fibonacci line is, which for whatever reason, the stock market basically bounced off of a couple of weeks ago. The reason I know this is probably right is because so many people use this. The fact that that's where it bounced tells me that's where the smart money is looking. But I think this rally, just like this rally and this rally and this rally, this rally and this rally, I think this rally leads to another downturn. And this area just above the 618 line is probably where we're headed. Now, we can get down here into Jeremy Grantham zone. We can. I don't think the Fed's going to let us, because the Fed knows, and if you listen to what he says between everything else he says, Powell understands the demographics, and he understands that oil is about half of inflation. He also understands that he's already started to cool off the real estate market. Go on Zillow or Realtor.com and take a look at all the arrows. The arrows are pointing down now. $10,000 price reduction, $30,000 price reduction, really expensive stuff, $100,000 and $150,000 and $200,000 price reductions on houses that were $1.3 million a while back, and now they're 1.1. The rental market has loosened up. Why? Like I told you at the start of the year, there's a record amount of inventory hitting the market. All sorts of rental units are coming online from now until the end of the year. They've already started. All sorts of new dorms and college housing that we talked about a couple of times. Remember, high prices are the cure for high prices. If there's a high price on something, somebody is going to make more of it, even if it's housing. And eventually, a lot of this commercial real estate that I see on LoopNet is going to get converted into other uses. I'm looking for a very specific type of building on LoopNet. And I found one finally, right? I'm looking for brick structures because I can't afford the high-rise office buildings that I'd like to convert into, luxury condo buildings. I don't have that kind of scratch. But that's what's coming with those too. You're going to see office buildings, the top floors, I think the top floors are going to be converted into maybe 4 condo units, 2 to 4 condo units. Why 2 to 4? Because the plumbing will support it. It's that simple. The plumbing will support it. Sometimes things are just that easy. So you put in executive suites at the top of some of these commercial office buildings. So S&P 500 has come down right to the range I said it would, but the top of it. And everybody asks, well, will it get to the bottom? And the answer is probably somewhere towards the bottom of this orange box. This is the first line of resistance. This is the next line of resistance. On the way down, it's support. This is the first line of support. This is the second line of support. If it breaks through this second one, that means something really haywire has happened. And then we get down in here. Don't think it's going to happen, but we can't discount the possibility. And what do we do if we're fully invested around here? It gets down to here. You hold your nose because the Fed is coming to the rescue. That's what you do. You don't sell and panic and say, whoa, what if it all ends? You say, well, the Fed's going to print a couple $1 trillion and it'll go back up. So you do the best you can to scale in from here to here. If you have a few percent left to invest down here into call options or something, go ahead. But you need to start thinking like you're a buyer again. I've been hinting at that for a month, 2 months. This next dip down into here, 350-ish on the S&P 500. Look, right? Resistance became support. So this area right in here, 330s, 340s, 350s, make sure you buy something. And I think you can get into the large caps. I've been telling you to buy the media stocks. AT&T, you could probably buy it right now if you really wanted to. Kinder Morgan, right? That was lower a week ago. Stop asking, can it go lower? Just stop. Get over the emotions. Control your emotions. Visualize what's going on. Have a step ladder approach spaced out by, rather large chunks, right? Don't invest every 2% down. Double-digit numbers. That's how you get lower cost bases. And realize that a lot of the stocks that we've been looking at have already fallen. If we take a look at the relative strength index on the weekly measurement, right? Measured every Friday. And I'm using a 13 period just because I want it to coincide with quarter. Normal is 14. So this is just a little bit faster than what everybody else uses. And I use a weekly rather than a daily. Bounced off of this line twice. It's going to break through the next time. Then it probably comes up, comes back down, then off to the races. How do we know that? Because the monthly, which is measured at the end of the month, and 13 is close enough to 12 for the years. I'm fine with that. So maybe this one's a little slower, but not much. 1/13 slower. You can see that we have been flirting with what has historically been normal bottoming, but not financial crisis bottoming. I don't think we're going to get into this white area. I don't think we're going to get an RSI below 30, but I think we will get one in the 30s. So in here. Why do I think that? Very simple logic. I don't think we're nearly as bad off as the financial crisis, pre-financial crisis, because the financial system is that much stronger. It's just tremendously stronger. The counterparty risk just isn't there. There just aren't that many bad loans. Most of the bad loans are student loans, and eventually 80 to 90% of those are going to be forgiven. It's what has to happen. So anybody making under like $400,000 a year is going to get their student loans forgiven. And for sure, anybody making 5 figures is going to get their student loans forgiven, especially if those student loans are older than 25 years old. People who are in their 50s, they still have student loans. It doesn't make any sense. You're just forcing them to be dependents in retirement. Why not forgive their loans now and let them save for retirement? Maybe you create a program where every dollar they invest into a retirement plan gets them a credit towards their student loan. Put money into a retirement plan and take that much off of your student loan debt. It's not really that many moving parts. Pretty easy to do, seeing as the federal government owns almost all the loans now that Navient and some of the other big ones have gotten out of the business. There's a way to fix everything. And it's not hard, and it's not expensive, and it's not unreasonable. Yeah, but I paid my student loans. Oh, hey, great. The whole economy is going to be better by doing this. You'll benefit from that. But whatever, man. Seriously. Think about the big picture, because that's good for you too. So as we start to take a look at stocks, we know what we want to own. I've started by Unity and Block. I have a PBW position from having traded it a couple times. You can just scale in. QQQ, right? The man bag stocks are what you should really be focused on. Microsoft, Amazon, Nvidia, Berkshire, Apple, and Google. Yeah. I know Berkshire's not a tech stock. These are the most powerful, strong companies in America, these 6. Put them in your man bag. Sling it around your waist. Walk down the street nice and proud with your man bag, right? I haven't finished editing this article, but I started putting in the minutes about Bitcoin. Now, so I'm going to finish on Bitcoin because we're already getting towards an hour. I understand that most people don't understand what Bitcoin is. I get it. But I've been watching this now for about 7 years and learning more and more and more about it. What if I told you over and over and over again, what is the most important thing to do when you want to know how things work and how they're going to turn out? Do what? Follow the money. And we are past, starting from a number of 0, we are past 1/4 of the family offices investing in Bitcoin. And I would imagine that by the end of the year, it'll be half-ish. Why is that important? These are the 1%ers, and they're buying Bitcoin. And they're buying it on the cheap right now. They're absorbing all these blocks that the retail market is selling. So as the little guys close their accounts and they take their $583 based on 0.0046 Bitcoins or whatever it is they owned, because they needed to pay for gas and they needed to pay their rent. They needed to pay for that vacation to Europe that's cheap right now that I'm planning to, right? This dollar being up here, if you want to travel to Europe, go this fall, or at least plan it for the spring, because Europe is cheap right now. I said way back in the 1990s that eventually the euro, over a generation, would fall to parity with the dollar because the United States has a better economy. And it just happened 20 years later, 25 maybe. I don't remember when I was saying that. I know I wrote about it on MarketWatch in 2012 and 2013. So when you take a look at Bitcoin, could it trade down a little bit lower on some last panic sell-off? It could, but here's the evidence that it probably won't. If you go to Glassnode, they have an article up. It's called The Expulsion of Bitcoin Tourists from a couple days ago. And what it shows is a nifty chart. It shows that the number of Bitcoin accounts has been coming down, and it's kind of at the bottom of a channel. Could it go a little lower for a hot minute? It could. But what that means is all the small investors have been selling. You're people who dipped a toe in, they lost money, so they ran away. Or they made some money and they started to go away, so they sold it before they lost it all. Typically, people buy something, call it at $1, and say it goes up to like 2 something. They don't sell anything up there. But as it comes down, back to 2, and then back to $1.70, and then to $1.50, and about $1.30 is where they start to sell. And they don't finish selling usually until it's around 50 cents. It is classic. People just hold on at the top rather than, sell half of your profit. And if it keeps going higher, sell the other half of your profit. If it keeps going higher from there, sell part of the original principle. Scale in so that you can scale out. I believe, as I told you in the summer of 2020, that you should take some of your bank savings, right? You're all investors, so you got to have some bank savings, and put a high single-digit percentage of your bank savings. So if you got $10,000 in the bank, put $1,000 in the Bitcoin. If you have $100,000 in the bank, put $10,000 in the Bitcoin. If you've got $250,000, put $25,000 or even $50,000 at that point in the Bitcoin. But do it not all at once. Commit to the number and then do it over the next 18 months. If you're conservative, If you want to be aggressive, do it over the next 6. Because as the super wealthy buy, eventually all the retail scaredy cats run out of cash. In this case, they run out of Bitcoin to sell. And that starts pushing the price back up. Bitcoin is digital gold. It is a holding value. It is a store of value that doesn't require a physical asset like real estate, which has carrying costs. And more Bitcoin is never going to appear, right? There's a schedule. And people lose it all the time. So I think a high single-digit percentage of your normal savings should go into Bitcoin. Now, if you really want to try to make a lot of money on Bitcoin, you take a look at some of the Bitcoin-related stocks like Block, which I've told you I think is my favorite mid-cap. Block, Square Block. And then the speculative one I'm in is Marathon, which they're going to have to manage well. But if they do, things go roughly, fudgeable timelines here. But if things go roughly as they have planned, and the price of Bitcoin still gets to 100,000 like I think it is, like in the next 2 years, Marathon goes up way more than 5x. Bitcoin will go up 5x from here, give or take, but Marathon could go up like 25x. And if I'm wrong, your $5 stock goes to $1, and they sell their computers into real estate. And, it's a relatively asset-light model, but, they have things they can sell. But I'm probably going to be right about Bitcoin because all I'm doing is shadowing the richest 1% of the people, which is what I do on a lot of things, almost everything. Every now and then I lead them. Like I bought Apple, and a year later, Warren Buffett bought Apple. I bought Viacom Paramount, and a year later, Warren Buffett bought it. There's a lot of cases where I buy stocks sooner than the big guys because they have different constraints than me. The CIO of a gigantic registered investment advisory. I got the top 10 in the Midwest. Once said, I've been watching you for years. I've talked to your uncle. You are almost always a year too early. And I've brought in technical guys to fix that. I might be a year too early on these small caps. I might be a year too early on Bitcoin. Maybe my technical guys haven't helped me fix it as much as I thought. But if you're a year too early on something that ultimately goes up 10, 20-fold for you, are you really going to be irritated that it wasn't 30-fold because you were a little early? If you scale in over the course of a year or 6 months or 18 months, you get a pretty good average price. Dollar cost averaging, and I'll finish with this. Dollar cost averaging is best done at price levels, not particular dates on the calendar. Do you understand that? Look at the price levels, the technical levels, and invest at 3 or 4 or 5 or 6 of those versus saying, I'm going to invest on the 25th of every month. Doesn't make any sense. What is the stock market or the currency market doing on the 25th of every month? Who knows? But when you get a 15 or 20 or 30% reduction in price, you buy a little bit more. If it happens again, you buy more. If it happens again, you pray you're not wrong and you buy more. Or you do more studying and you realize, oh, crap, I am wrong. I better take the tax break before it goes down more. Done that on one stock so far out of this whole basket. And I was on track. I haven't taken the tax loss on anything else. Now, I manage other people's money, so I maneuver a little bit to get those tax breaks. But I still believe in Kazoo, even though I sold it and sold options on it. And I'm going to get it back at $1, it looks like. People are still going to get the tax break for selling it at $1.30 or whatever we sold it at. There's a couple of satellite stocks. I jitterbugged like that too. You can trade around and use options to capture a tax loss. And then you sell, as long as you sell the put at the same price or lower over a month out, you get the tax break and you get the stock just put back to you. In the rare case where the downward momentum breaks and it shoots straight up, you got a little bit more work to do. But dollar cost average into this market, folks. It's time to start and do your dollar cost averaging based on, where's my chart? There you go. Do your dollar cost averaging based on price levels. A little bit in the 350s, a little bit in the 320s. Then start backing up the truck if it gets to 300-ish. 6 of your money, 30 of your money, the rest of your money. That's where we're at. This blow off top, it's got another leg or two down, and maybe three, but I think 2, because I think the Fed will back off in September. And that's my official prediction. I think the Fed backs off in September. I think they ever jump the withdrawals from the balance sheet up. I think they keep that level. The only problem is where the meetings are. And I also think that they stop raising interest rates this year. I don't think they ever get to 3.8%, which is the hypothetical neutral interest rates. And it's just some random number they pulled out of their ass. But we are going to see slightly higher interest rates than we did during the crisis periods. They might come back when the boomers start to really weigh on the Medicare system. But there's a way to fix that too, and it's not even expensive. That's one of the things that one of our subscribers has been talking about. There's a way to fix the healthcare system. It's going to piss off some doctors who gouge, some systems that take advantage of an ever-increasing pie. You know that healthcare is like twice as expensive here as Europe and Canada, and yet they have the same outcomes or slightly better than us. Maybe we should be learning from them. Everything's fixable, and generation to generation, everything has always gotten better. Even though we go through short periods, we call them recessions, where things feel like they're getting worse. And it's complicated today by things that happen with people who shouldn't own guns owning guns, right? We see that in the news. People with mental issues have guns. Kids that fall through the cracks because nobody will take them under their wing. So I'll finish with that, actually. You really want to do something good in your life? Do something good for a kid. That makes everything better. All right. I hope everybody had a wonderful Independence Day, whether you were in Canada or France or United States, wherever you were. There was a number of them. Ours was July 4th, and it's thunderstormed here, so I didn't even get fireworks. So I'm going to have to track some down. All right, everybody, the stock market is in the final stages of the bear. For the next several months, it'll bottom. It might double bottom, it might triple bottom. But by next year, things are going to be getting better. And I think that if you are not planning to be a buyer here the next 6 to 18 months, just call me up and I'll manage your money for you, because that's where you need to be. You need to be looking at this chart and saying, oh boy, we're going to get one more drop here and then a rebound, then another drop, then we'll see where we're at. Probably a jitterbug and rise, but if the Fed doesn't scare the hell out of everybody when they back off, which is a possibility, it might scare people into one more bottom. Oh, look, the Fed's backing off. The world's going to hell. No, it might just be that they've contained inflation by slowing demand growth. We're already seeing it, actually. Already starting to see it. Demand growth for oil is basically flattened out. New supply of housing alleviated some pressure there. People not overpaying for real estate. Pressure relief there because of the interest rates. We might be really close to this weird place called equilibrium. Now it's just a matter of seeing where the prices settle out. All right. Take care, everybody.